What's up, everybody? It's the Digital World Podcast, and we're back at it today. And I think this graph, tied in with this information, is really gonna put everything together for all of you watching, because the 30-year fixed rate mortgage, right, has just been climbing. If you see it bottomed around. Let's see if I can zoom in here. So around, let's say December 2020, and you can even say put in a double bottom on August of 2021. So we see that, and they just been rising, right? Just drastically going up quick, right? They had like a max peak of 7.79 in October of 2023, and we see that right now we're basically at 6.86. Um, some estimate that it's around like 7, if not higher. Um, and so this is just from Freddie Mac, right? Their economic data. So, but what you're seeing is, and this is what I wanted to show you guys. Look at these levels, right? When was the last time we were at those levels, 6.8? And you'd have to go all the way back to 2002, where we saw this type of levels for mortgage rates. And so, um, what's interesting is that the bond markets, they tend to go in you know multi-decade long rallies. So, for example, if we're looking at the 30 year yield, right, it's down at 5.04, peaked yesterday at 5.09. If the yields on a 30-year treasury bond, right? If these yields are diminishing, right? If you look over here, pretend like this is the 30-year. Actually, I mean, let's actually try to find a 30-year. Okay, let's look at all of it, right? For the history of it, let's look at the past 30 years. We've seen a decreasing trend here, negative correlation, right? For this 30-year treasury bond. Now, whenever you have lower yields, right, the face value of that bond increases. But if you're having increasing yield, the face value of that bond is diminishing in value. So, in other words, it's like saying, hey, I, at the top over here in 1987, let's say the face value of the bond was $1,000, right? As it's dropping in yield, the face value of that bond is going to increase, right? So it's a bull market trend. So over time, instead of, let's say, down the line in 2010, yeah, you have a lower yield, but the face value of the bond, instead of being $1,000, it's not going to be $1,050. So technically, you've gained $50 on that bond, right? Now, those multi-decade trends only last about, it could be, 30 to 40 years. And by the time it turns and people realize it, it's already, potentially already been in the uptrend for quite a few years. And so what we're noticing is, could it be that March 2020 was the bottom or the end of that bull trend rally? And now we're headed towards a bear market for bonds. So yields will go up and the face value of those bonds will diminish. So instead of, if it costs $1,000 to buy it here, now it's gonna cost $950. So that value of the bond has decreased in value. I hope that makes sense for everyone. So, anyways, could it be that if we're in a bond market a bond bear market, that what we're gonna see is increasing interest rates on your mortgage? Now, isn't that something? So while people are saying, "Hey, just buy your home for 6%," and wait for to refinance when we get lower rates. What if we never get those lower rates again? What if this was the last opportunity here? Albeit you had astronomical values on those houses, right? In order for you to get this mortgage rate, your house was like way expensive, where you had like 50 bidders on one house. So, what I'm saying is, what if for the future, mortgages, you start seeing higher interest rates, but don't necessarily see more or higher value as far as the face value of the house? Now, that's an interesting question, right? And I'm posing it. I'm not saying that's what's going to happen. I'm asking, what if? And so I think, if you look at the communication from the Fed, they're saying higher for longer. And what does that mean, right? So it's anyone's guess what can happen, but it's important to note, right? These trends that are multi decades long, right? Like you see it peaked here in 1981. And could it be that we bottomed in 2021? Something to really think about. So, with that being said, I want you guys, and I'm going to be harping on this, right? For my main focus is going to be on mortgages. And we're going to be watching this 30-year treasury yield and see where it goes. But whenever you start seeing these, like let's go ahead, like when you start looking at, the 2008 financial crisis, right? You see here the value, like the yield was at 2.68, and we had a rally all the way up to 4.71. And that was screaming, right? That was telling you what was coming. And so, I mean, if you look at Japan's, I believe it's the 40-year treasury yield has reached, I believe it was like 3.46, or it might have been 6.4 actually, which is the highest this century, right? So bonds across the world are telling you, they're flashing the red signal of warning. And I think we have to pay attention. And that's why you got to be very cautious, right? I think it's the education. We need to be educated on these things, right? So we can make the best financial decisions for ourselves and our families. And that's kind of where, looking at these charts, right? Yeah, sometimes it takes years to play out. But nevertheless, everyone is their own economy, right? You make the best decisions that you can based on your economy, right? Anyways, thank you for watching. Let me know what your thoughts are. What do you see in your markets, in your area? Would like to hear if you're seeing a lot of homes up for sale. All right. Thank you for watching. Like and subscribe to the channel. This is the Digital World Podcast, and I'll see you in the next episode.